Welcome to another 21 Hats Dashboard. I'm Lauren Feldman, and I'm here with Gary Kunkel, who is an economist who identifies himself on his LinkedIn profile as a sustained growth researcher. Welcome to the podcast, Gary, and please tell us, what exactly is a sustained growth researcher?
Thank you, Lauren. I'm happy to be here. Well, sustained growth researcher just essentially means that I'm trying to untangle the mystery of why only 1% of the companies are generating 2/3 of all the employment. And these are the companies that grow again and again. So what makes them different than all the other companies that are flatlined or in decline, or only have, one growth event every, 5 or 10 years? What makes them different? How are they making decisions differently? And that's what I research.
That's a really interesting topic, especially to business owners, and I want to explore that with you. But first, take us through your background a little bit. Have you ever owned a business?
Yes, I have, as a matter of fact. So when I was about 40 years old, I found myself in Europe with my own consulting company at about 12 employees. And our biggest client was the state of Maryland. And we were doing foreign direct investment attraction. So we were trying to get European companies to build factories and facilities in the state of Maryland. And the key to that is to try to get to them in that small window of time when they're making a decision, where they're trying to evaluate where they're going to put their plant, for instance. And so I knew that my job would be a lot easier if I could come up with some kind of predictive methodology that I could whittle down tens of thousands of companies down to a small group that I should focus my attention on. So I gathered data sets and started playing with predictive models and became really fascinated with that. But I realized with a bit of humility that I didn't have the statistical training and the background really to do this kind of work. So I exited the contract with Maryland, and I came back to the States to get a PhD focused on sustained growth and what the impacts are on regional economies.
So what was that experience that really spurred you to develop this area of expertise?
It was. So while we were doing the project, we had this data set, this unique data set that tracks every company in the economy. And so I was working with Pennsylvania, the data set with Pennsylvania, and we had about 9 million companies in Pennsylvania that had survived a 5-year period of time. When we measured it, we found that 1% of those companies generated about 2/3 of all the jobs. And we played that backwards and played it forward in time, and we saw the same pattern. Subsequently, I've done studies for Pennsylvania, which I just said, Virginia, Texas, Louisiana, and Michigan. We see the same exact pattern there as well. The numbers, it's always about 1%, could be a 0.5% to 1.5%. It averages about 1%. And on average, they're creating 2/3 of the jobs. So that came to us as a big question: is what are they doing differently? And I'm a behavioral economist, so wanted to think that it was their decisions that they were making, the behaviors that they had that were different. So we cataloged about 500 variables, company characteristics, decisions that were made that were supposed to be connected to growth. So everything from open book management to how much money you spend on R&D to whether or not you have bike racks or on a public transportation route.
Wow.
All of these kinds of crazy things, right? And we collected thousands of surveys from CEOs across the growth spectrum in order to compare what was that top 1% doing differently than the other 99%. And when we boiled it down, we found that there were only 50 decisions that separate these companies, the ones that are in the top 1% and the other 99%. And this set of 50 decisions is what forms the basis of the executive leadership training that I do for Tugboat Institute and on my own separately.
Well, I'm dying to hear. Give us a hint. What are those decisions that make the difference between growing or not growing?
Well, before we answer the question, I just want to say that a company is a complex system. So we have decisions that can culminate in an outcome that we can't get directly. So all these decisions culminate to push six things forward. These six things really are the drivers of sustained growth. So do you attract high margin customers? Can you keep high margin customers? Do you introduce new high margin offerings? Do you keep margins high on existing offerings? Do you have pricing power and excellent cash flow? So those are the six things that come out of these 50 decisions. And so we link them back to those, you know.
Explain what you mean by that. How do you link decisions to high margin customers?
So one of the things that we use as a tool is something called the customer profitability whale. And this is a diagram that is sort of indicates the way the typical company is configured with their customers. So if we were to line up all of a company's customers, and the first person in the line is the most profitable customer for the company, and at the end of the line is the least profitable, and we chart those against cumulative net operating profit, we find that the first like 20% of customers, the most profitable, are responsible for as much as twice or more of your net operating profit. So they drive the profits way up. And then you've got about 70, 60, 70, 75% of companies or customers in there that are not profitable. They're just right at the line. And then you've got about 15% of the customers that you're losing money on. So what we're trying to do is isolate into that top 20% where you're generating most of all your profits are. And that's where we want to do a very determined customer acquisition and retention. That's where we want to innovate new products and services in there. That's where we want to have pricing power. And that's going to drive our excellent cash flow.
You gave us those 6 factors that explain why that 1% of companies that you look at are responsible for so much of the growth. And the 6 factors you identified are all things that the companies are very much aware of. They know it's good to have high margin customers and high margin offerings and cash flow and pricing power. Everybody's trying to do that. I'm wondering, what's the difference between those who accomplish it and those that don't? Have you figured that out?
Yeah. So at Tugboat, we train companies. We train 25 companies, about 300 executives, and they range in size from about 10 million annual sales to 1.2 billion. So it's a big, wide variety. But what we've got to see throughout that is that part of this is scale dependent. So if you look at a smaller company, say 10 million sales, 5 million sales, something along that line, they're going to intuitively kind of know which of their customers are more high margin than other customers are. And they would intuitively understand that there's some that they're losing money on. But they don't have necessarily the investment in the ability to determine what those really are in a numerical sense, in numerical terms, right? The way that we get there is through cost accounting, activity-based costing. That allows us to really analyze. We can do it at the transaction level, or we do it at the customer level. We do it at the market level, the product level, whatever we want to do. But in this case, we're talking about customers. So we see that as companies move through the middle market phase, they start to formalize some of these activities. Around, and this is a really loosey-goosey number, but around 100 million in annual sales is where I really start to see that the businesses are able to quantify this distribution of profits across customer base. And that's really essential if you want to start really drilling down into, well, why are they there? And, what kind of features are they buying? What distribution channels are they buying from? Where are they geographically? Other characteristics that'll help your hunt for these best customers as you go forward. And in a way, it's similar to what I was doing in Europe.
How so?
Because we're trying to find activities and characteristics that are indicative of growth for the future, that tell us that we're pointed in the right direction. And there's really no stronger tool than activity-based costing and cost accounting. As dull in quotes as that may seem, it is penetrating insight.
And you're saying that generally, in your experience, there's a dividing line somewhere around $100 million, and companies below 100 million typically don't necessarily know the extent to which their best customers are providing most of their growth?
Well, there's a difference between sort of instinct and numbers on a page. So that's what we're trying to get to is to really be able to quantify uh, who those customers are, who are the ones that you want to replicate, who are the ones that you need to shift along that curve so that they're not marginally profitable anymore, that they're actually profitable. A lot of that can come into transaction costs, are one of the reasons why some of those are marginally profitable, because you spend a lot of money and time trying to acquire them, but they only buy from you once. So that when you net that out, you're netting it out close to zero profits. So you're able to treat that more determined in a more measured way, and also the customers at the end of that tail that where you're really losing money on, either shifting those to another point on the distribution or getting rid of them.
So you mentioned you do these kind of analyses for on your own for companies, I guess, that hire you directly, and also through the Tugboat Institute. The Tugboat Institute is a terrific organization based in Idaho, created by Dave Wharton, and they practice something called evergreen growth. Their idea is to build a business that can last 100 years. They discourage sales to private equity, venture capital. They like owner operators. Is that fair?
No, it's very good. And it is an excellent organization. The members are really dedicated to growing their company in a paced way, like sustained growth, same thing, really driven by their purpose and perseverance. It's a great organization.
You mentioned the sustained growth again. Is there something magical about sustained growth as opposed to haphazard growth, or when it happens growth? Why sustained growth as a focus?
When I started this, I looked at all these academic articles and books that had been written that were looking at different kinds of growth. And in the past, when people were saying that a company was growing, usually they look at the percentage of growth or the absolute amount of growth. What I did is I introduced a new variable, a new dimension on this, and that is the number of times a company grows. And the reason why I did that is because it's like most human activities. The more times we do something, the better we get, and then the more likely we are to do it again. So what we want to do is get inside that process so that growth is repeatable over time. It's interesting because we took the 9 million companies in Pennsylvania, and I looked at all three of those growth measures, and I was trying to see if those three growth measures would predict. If we looked at how a company grew over a 5-year period of time, and then we looked at the next 5-year period of time to see whether or not how they grew predicted future growth, we found that absolute growth, the total amount that you grew in a 5-year period of time, has no bearing on whether or not you survive or grow in the next 5 years. The faster you grow, it's actually negatively correlated. So that means that the faster you grow, the more likely you are to go out of business. What we did find highly significant was the more times you grew in the past, significantly higher survivability in the future, and more likely to grow again and again in the future. So it becomes sticky. So if we can get companies through this sort of episodic one-off growth and put them on a track where they can grow again and again and again. Now remember, all of this growth is highly profitable growth. We're not growing at a loss. We're growing in such a way that we can support the profitability and do what we need to do as companies, which is to serve our shareholders as well.
So that has interesting implications, what you just said. I like you, I used to work at Inc. magazine, where for a while I was largely responsible for the Inc. 500, Inc. 5000 list of fastest growing privately owned companies in America that we produced every year. If I heard you right, what you're saying is growing really fast, being at the top of that Inc. 5000 list is kind of dangerous. Your chances of going out of business are much greater than if you're growing consistently at 5 or 10% a year. Did I hear you right?
That's right. So one of the reasons behind this is debt. So companies that are looking to grow really fast are usually out there raising a lot of debt in order to do that. When you build capacity at a rapid rate, or you exceed the growth in demand, you're going to get yourself in a position where you have a cash flow problem. You've got to pay for the note for all the debt that you did, but you don't have, the business hasn't caught up. So it leaves you in a really vulnerable position if there's a market downturn or sudden competitor shift or something else along that line. And that's why we see the faster that they grow, the tends to be the more likely that they are to collapse.
Interesting. So I was asking you about the Tugboat Institute before, and you do these analyses on their companies, and I've been to several of their conferences. I've met a lot of the owners of the businesses. They're fabulous businesses. It's an amazing organization, as we were saying. I'm curious what your typical experience is when you do an analysis on a really successful company like that. I mean, it costs money to be part of the Tugboat Institute. These are largely successful businesses that you're dealing with. When you go in and do this analysis, what's your process and what do you typically find?
Well, the analysis usually comes through the training. So we run the companies that are training clients through 7 modules of information that comes from the research. It shows them, we go through the customer profitability whale, we talk about complex systems, but then we drive down into the 50 decisions that really are supporting sustained growth. And as we do that through questions and answers and an extensive sets of surveys that we ask them as they're going through, we ask them to identify the bottlenecks that they see in their own company as we go through, decision after decision after decision. Is this a big problem? Is this something you got under control? And this becomes a self-diagnostic for them because we've given them the information on how to think about these issues. Really, what we've done is we've given them a tool to prioritize. One of the things that's really true is that as a company scales, complexity rises a lot faster than you expect. So what we're trying to do is put them in a position where they're thinking about the 50 or so decisions that they can make that have the most leverage on growth.
And what's the reaction like typically when you share this information and allow these owners to self-diagnose and they realize that they've been devoting a lot of energy to unprofitable customers and not putting as much energy perhaps as they should into their most profitable customers? Are they stunned? Because these are all really well-run companies. What do you hear from them?
I think that there is a little bit of a stunned moment there. It's one of these moments where you're moving from a position where some of these topics, these decisions, they're intuitively known, but they haven't been concentrated on. So they don't really realize how important these parts of these decisions are, so that they are really attuned. Of course, when you're talking about like the customer profitability whale, when you put that up there, they can immediately identify which customers are going where on that. But they never really had a conceptual framework that they can talk about it among themselves. And that's one of the big things that they take away from the training is a common language that they can now talk about these issues. They know how important they are, and it focuses the team on problem solving.
I think you used the term customer profitability whale. What does that mean?
Correct. That's a diagram that essentially plots out customer profitability along the X or horizontal axis and cumulative um, gross profits on the Y or vertical axis. And when you draw it out, it kind of looks like a whale. So at the head of the whale, you got the top most profitable 20%. Then you've got this long back kind of sloping downward, which are the ones that are marginally profitable. And then the tail of the whale is where you have that 15% or so of customers that you're losing money on.
So it's roughly 20% high margin, 60% a wash, and 15 or 20% where you're losing money?
That's correct. It's kind of a rule of thumb, and the numbers will be a little bit different for every company, but that's the construct.
And for almost every company, you're saying?
For just about every company, yeah. And one of the reasons why is that when we start off in business, maybe we have one customer and we do a great job on that. Somebody else hears us and then they come to us and they want something a little bit different. And that customer is a different kind of profile as the first one. Then we had a third one, also very different, wants something different. So we get this proliferation of different profiled customers wanting very different things. And so it's not until you sort of build up that pattern and you start realizing that not only is profitability really strong within a subset, like 20%, and that we're losing also on about 10 or 15% on this, but also we can see the same pattern when we apply this cost accounting back to which products, add-ons, distribution channels, or other dimensions. We can do the same analysis, and that'll show us as well, this product line, we're killing it on, but this one over here is killing us. Or this distribution channel is very. So it's a way that we can set up the numbers so that we can do an analysis to make better decisions.
And you've really found this across the board from relatively small companies with, say, $5 million a year in revenue to very large companies and across industries, across geographies?
Yeah, the typical motivation behind this is because all companies are facing this once they get a little bit of mass to them. As you said, about 5 million or something along that line. When you've got depends on the company and what they're selling, but as soon as you've got a good sized collection of customers, you're going to get a pattern that looks somewhat similar to that.
And what's the logical next step for most companies who realize that they in fact fit this pattern? What do you advise someone in that situation to do?
Well, as we're going through the training, and particularly with Tugboat, we have a capstone at the end of the course, which is a half-day problem-solving workshop. And as they've gone through the training, through surveys and discussions, we've gotten them to identify which of the topics, which of the decisions that we're talking about, which of these decisions are they having problems with? And then when we go to the whiteboard at the end, we pick 4 of those and we drill down into those. So we say, what does an optimal solution look like? Well, we start off with what is the nature of the problem? What does an optimal solution look like? What kind of data do we need or information we need to make a decision? What kind of other resources are involved? Who should be involved particularly? And what are the first steps? And what are the hidden risks? So those 6 dimensions there, we go through each of these 4 problems and try to work that out so that when they get finished with the course, they've got, a set of topics, assignments, if you will. Most of the companies, as we're going through this, actually assign people on the executive leadership team to champion one of the problem sets to see it through into implementation.
Does it usually end up with the company deciding that they either have to get rid of that 15 to 20% of customers that they're losing money on, or raise their prices considerably?
Well, there's a variety of different things that they can do. A lot of the reason why, again, that we have marginally profitable or negatively profitable customers is because of transaction costs. And you can think about these as all the extra costs that you would spend. You can kind of think in your mind on a customer that's too demanding, if you will. We have to do special shipments for them. We have to pack it separately. They want a different color than we've got. They want it delivered in a certain way. We have to chase them for bills. There's all of these extra costs that go along with serving the customer. That's usually not what we're including when we think of the profitability of that customer. But through activity-based costing, we can assign those costs back down to the company so we can see where they are. And some of it can be as simple as charging for some of these special handling things and whatnot, so that you're not losing money on those. That's a softer thing than essentially firing your customers, right?
So for people listening to this, some of whom are less than $5 million, but there's probably still a chance that they fit the pattern you're describing. If somebody is concerned that they do in fact fit this pattern, what would you suggest to them?
Well, I certainly would be happy, to talk with them.
You want to give your email address?
Oh, certainly. My email address is gmkunkel, Kunkle. That's gmkunkel@yahoo.com. That's my personal one. And I have a website at sustain-growth.com.
But any first steps that you would suggest if somebody suspects that they fit the pattern, other than reaching out to you, which obviously would be a fine one?
That would be a fine one. Yeah. I think, one of the first things that they should do is really take a look at the distribution of your customers by profitability. That's one of the first thing. Now, when we do the training, we've got 10 sessions here that we're doing the training on, and we don't talk about cost accounting the whole time. We just set up the model and then we move through. So don't think the training is all cost accounting stuff. It's not. But it sets forth a sort of a conceptual model that we can work with. And we can say, okay, now that we've got this, so the first thing I do to answer your question would be, do we really know who our most valuable customers are in true terms? And do we know the ones that we're subsidizing on the back end? What should we do with those? What should we do? Replicate the good ones and manage in some ways the ones that are not profitable.
Got it. So I just have one other question for you. We talked about the kind of the myth of fast growth. I mean, so many businesses are focused on their annual growth percentage. That's the whole point of the Inc. 500, Inc. 5000, as we discussed. People are very proud to make it onto that list.
Of course.
Are there other things we get wrong about growth that you would call our attention to?
Well, we've spent a good bit of time here already talking about how poor growth quality zaps growth momentum. If we've got too many customers that we're losing money on, that's going to zap our momentum. If we have more customers that are aligned in the high profitability zone, it's going to help us. So trying to manage that is a big thing, and that's what we've talked about here throughout. But there's a lot more dimensions that we go over during training. We talk a lot about decentralization. Decentralization is so important as a company grows, again, because complexity and the number of decisions that are made is going to expand with scale and at a very rapid rate. So that's one of the reasons why executive training is important, but it's also important for decentralization. How do you get your people to be working in pursuit of the vision, the plan, and the target, how do you incentivize them and lead them so they're motivated to do that? Um, that's gonna go a long way.
Got it. Gary, I suspect you've opened a lot of eyes with this conversation, and there are going to be a lot of owners who listen to this who take steps to find out whether they, in fact, are fitting this pattern. I really appreciate you taking the time to speak with us.
Thank you very much. I appreciate that.
Gary Kunkel is a sustained growth researcher. Gary, let's keep in touch. I suspect there's more to talk about here.
Absolutely. Thank you, Lauren.
Thank you.